Imagine going to sleep thinking your home is fully protected. I mean, it is probably your biggest financial asset, right?
Right, absolutely. You've been, faithfully paying into this policy for a decade.
Yeah. And then you wake up to find that a localized thunderstorm overnight has legally increased your out-of-pocket insurance bill by like 500%.
Which is just terrifying to even think about.
It really is. And that is exactly what is happening to millions of homeowners right now.
Yeah.
Entirely by accident. So we are talking about a financial freefall you don't even know you're in until you actually hit the ground.
Exactly.
Welcome to today's Deep Dive. Today we are decoding a really eye-opening public service announcement created by John Scranton. He's from an educational platform called Cash University.
Right, and their whole mission with this presentation is to uncover the hidden financial traps that are basically lurking right there in the fine print of homeowners insurance policies.
Yeah, the stuff no one reads.
Exactly. The goal here is to translate that dense, deliberately complex legal jargon into plain English. That way you can actually protect your household wealth.
Because for so many of you listening, homeownership isn't just about having a place to, put your couch. It is the ultimate wealth builder.
It's your retirement plan, really.
It is. But as the source material strictly warns, a single misunderstood provision in that massive packet of papers they mail you every year, that can wipe out decades of equity. So our mission today is to give you the playbook to avoid that devastation.
And to really understand the stakes, we should look at John Scranton's background for a second.
Right.
He actually got his real estate license back in 1993.
Oh, wow. Okay.
Yeah, and he eventually started specializing in finding distressed property owners, like right before they went into foreclosure. So he spent years analyzing exactly how people lose their homes.
And what he found out in the trenches was pretty heartbreaking, to be honest. He was seeing people who had built up massive equity over 15, maybe 20 years. But then, their circumstances changed. A storm hit, the roof started failing, and they just didn't have the cash on hand for massive repairs.
Yeah, it's a terrible situation to be in.
So they were forced to sell their homes at a deep discount, basically throwing away their life savings just to get out from under the crisis.
But the real tragedy, as Scranton later learned when he started auditing these exact situations, was that their homeowners' policies actually had provisions that would have paid for those roof replacements.
Wait, really? They had the coverage the whole time?
They did. But nobody ever explained the policies to them, so thousands of families literally fell through the cracks simply because of the language barrier in these contracts.
Okay, let's unpack this current landscape. Because lawmakers are actually starting to realize how bad this is getting.
They are, yeah.
We are seeing some new legislation pop up to try and combat this kind of financial disaster. The source specifically highlights a recent law passed in Georgia, and they note it might be spreading to other states pretty soon.
Right, the catastrophe savings accounts.
Exactly. This legislation allows homeowners to establish a catastrophe savings account.
It's a very specific government-incentivized financial tool. Under this law, you can put up to $250,000 into a specialized account.
Which sounds like a massive amount of money.
It is. Now, that massive $250,000 limit is specifically designed for rebuild costs if you are entirely self-insured.
Oh, okay. So that's for people without traditional policies.
Right. But for the average homeowner who does have a policy, this account is really meant to be dedicated to covering your homeowner's insurance deductibles. And these days, those are typically $2,000 or more.
Yeah, they've gone way up.
And the government is making it very attractive. The interest you earn on that money is completely tax-free. Plus, if you pass away, it transfers to your spouse tax-free as well.
Now, on the surface, I hear tax-free savings account, and I think, well, that's a massive win for the average homeowner. I can shelter some money and protect my house.
You think so, yeah.
But Scranton is incredibly critical of this legislation. Why is he practically sounding the alarm over a law that helps you save money?
It really comes down to what the legislation actually represents about the health of the insurance industry as a whole. Scranton uses this really visceral medical analogy. He says, imagine you have a severe, debilitating migraine headache, and you go to the doctor. The doctor looks at you, nods sympathetically, and sticks a Band-Aid on your forehead.
Right. And meanwhile, the aneurysm causing the migraine is still actively bleeding out your bank account.
Exactly the point. It doesn't solve the underlying sickness. This legislation is just a legislative Band-Aid.
I see.
The very fact that the government feels the need to let you shield hundreds of thousands of dollars just to cover insurance deductibles or out-of-pocket rebuilds is a glaring warning sign.
Right, because why should deductibles be so high in the first place?
Exactly. It signals that the traditional model of insurance is completely breaking down. Homeowners are getting absolutely clobbered by out-of-pocket costs.
Yep.
The legislation doesn't actually stop the insurance companies from passing those massive costs onto you. It just gives you a tax shelter to hoard cash so you can hopefully survive the impact.
It's basically saying, hey, you are going to get hit by a freight train, so here's a really nice tax-free helmet.
That's a perfect way to put it. The burden of risk is being quietly shifted entirely onto the shoulders of the consumer.
Which begs the question, what exactly is the underlying sickness here? Why are out-of-pocket costs skyrocketing so drastically? I mean, we all pay our premiums every month.
We do.
To answer that, we have to look at the fundamental way insurance companies value the most vital, vulnerable part of your property, which is your roof.
Yes, the roof is everything.
And that brings us to the trap of ACV versus RCV. I personally dread reading policy documents, but this is one acronym everyone needs to learn.
It really is the core mechanism of how people lose their equity. RCV stands for replacement cost value. ACV stands for actual cash value.
Okay.
And if you don't know which one you have, you are basically flying blind into a storm.
Let's break down the mechanics of those, because RCV is what everybody naturally expects when they buy insurance, right?
Right. It's the ideal scenario.
It pays the full cost to replace the roof, minus a flat deductible. So if your roof costs $20,000 to replace, and you have a $1,000 flat deductible, the insurance company writes a check for $19,000.
Exactly.
You hand over your $1,000 and you get a brand new roof. That feels clean, it feels fair, and it's exactly what you paid premiums for all those years.
But ACV, actual cash value, is a completely different mathematical reality.
And a much harsher one.
Oh, absolutely. The mechanism behind ACV is depreciation. They actually subtract the depreciated value of your roof from the payout pool before they ever cut a check.
Okay, the source gives us a really stark example to show how this math ruins people.
Yeah.
Imagine you own a townhouse. A storm rolls through, tears up the shingles, and a contractor tells you it's going to cost $10,000 to replace.
Pretty standard repair bill.
Right. But if you have an ACV policy, an insurance adjuster is going to come to your property to evaluate that roof.
And when they do, they're specifically looking at the age of the materials, the general condition, the wear and tear over the years.
Right.
So let's say they determine the roof is halfway through its lifespan. They assess a 50% depreciation rate.
This is where the math gets terrifying. That $10,000 replacement cost is instantly slashed in half.
Exactly.
The maximum payout pool shrinks to just $5,000. But wait, you still have your $1,000 deductible.
Yep. So they subtract that from the remaining $5,000.
Meaning the insurance company is only issuing a check for $4,000 on a $10,000 roof replacement.
Which means you, the homeowner, suddenly have to produce $6,000 out of thin air just to put a roof over your head.
You're paying more for the claim than the massive insurance company is.
Exactly.
I have to ask, though, why is the industry doing this? Are they just being greedy, or is there a mechanical reason behind this shift to ACV?
Well, it's a systemic issue tied to risk pooling. Historically, insurance models relied on localized rare events. You know, a house fire here, a tornado there.
Right, isolated incidents.
But with systemic weather changes, you now have massive regions getting hit by severe hail or wind simultaneously. Entire zip codes suddenly need new roofs at the exact same time.
Oh, I see.
So the traditional risk pool model is just breaking under the sheer volume of claims. To stay solvent, and yes, to protect their profit margins, carriers are fundamentally altering the contracts to push the financial risk back onto the consumer.
And what's fascinating, and frankly pretty devious, is how they are forcing people into these ACV policies without them realizing it.
Yes. The hybrid policies.
Right. Because I might sit down with my agent, read the fine print, demand an RCV policy, and think I'm safe. But Scranton points out that insurers are now using these hybrid policies.
This is a major, major structural change in the industry. Buried deep in your contract, you might have a trigger provision.
A trigger provision?
Yeah. The contract will state that if the damage is caused by a specific storm event like hail or severe wind, the policy automatically converts from a protective RCV policy into a punishing ACV policy.
Wow.
It downgrades your coverage based on the weather forecast, literally at the exact moment you actually need it most.
Wait, hold on. I signed a contract for full replacement value. How is it legal for them to just downgrade my coverage without me signing a new piece of paper?
Because you did sign it. It was just buried on like page 47 in a dense subclause about windstorm perils.
That is wild. And speaking of that moment you need it, when that adjuster comes to your townhouse to assess the depreciation, Scranton offers a massive warning.
He really does.
You have to remember the psychology of this interaction. The adjuster is essentially on a fishing expedition for the insurance company.
Right. They represent the carrier's financial interests. They don't represent your household equity.
It's like you're playing a championship game, and before the kickoff, you accidentally hand the opposing coach your entire playbook.
That's a great analogy.
You might think you're just making friendly small talk in the driveway. You might casually mention, oh yeah, that corner has leaked a little bit since 2018. We just put a bucket under it.
And you think you're just being helpful.
Right. But you just gave them the ammunition to classify the damage as pre-existing neglect, which drastically increases that depreciation percentage. Or it might let them deny the claim entirely.
Exactly. So the advice here is simple. Be polite, be quiet, and let them do their evaluation. Do not volunteer the history of your home.
It's very sound advice.
Yeah.
But aggressive depreciation isn't the only lever they pull. Let's say you survive the ACV trap. You audit your policy, you remove the conversion triggers, and you secure a true RCV policy.
You think you're safe, right?
Exactly.
Well, carriers have another mathematical sleight of hand to manipulate your out-of-pocket costs when you aren't looking.
They do.
Which brings us to the deductible bait and switch. Here's where it gets really interesting. This is where I personally had a massive aha moment reading the source material.
It's a shocking realization for a lot of people. We just talked about a flat deductible, like $1,000. But Scranton warns that policies are silently shifting from flat deductibles to percentage deductibles.
We really need to clarify how this math works because it relies on a very common cognitive bias.
Yes, please do.
When you hear 1% deductible, your brain naturally assumes it means 1% of the cost of the repair.
Right. So on a $10,000 roof, 1% would be $100. That sounds incredibly reasonable.
Exactly. But I'm sure you learned the hard way reading this that is absolutely not how it works.
Not at all. The percentage is actually based on the face amount of the entire policy.
Right.
And that is the total estimated cost to completely rebuild your house from the ground up if it burned to ashes.
Yes. Let's run those numbers to show the impact. Let's say the policy states it would cost $200,000 to rebuild your house.
Okay, $200K.
A 1% deductible on that face amount means your deductible is actually $2,000.
Not ideal, but maybe manageable for some.
But the source explicitly warns that these percentage deductibles can jump as high as 5%.
And 5% of a $200,000 rebuild cost is a $10,000 deductible.
Exactly.
Now, let me play devil's advocate for a second. Doesn't a percentage deductible make mathematical sense in the grand scheme of things? I mean, if I have a $2 million mega mansion, shouldn't my deductible be proportionally higher than someone with a tiny starter home?
The proportional math makes sense in theory, yes.
Yeah.
The trap isn't necessarily the existence of a percentage deductible itself.
Okay.
The trap is the bait and switch. Scranton explains that a standard flat deductible of $1,000 can automatically flip to a 5% percentage deductible if the damage is caused by a named peril, like wind or hail.
So it goes back to those hidden weather triggers.
Exactly. You go to sleep thinking you have a $1,000 deductible. A severe thunderstorm hits overnight. Because the damage was caused by wind, your contract triggers the swap.
Just like that.
Literally overnight, your out-of-pocket requirement spikes from $1,000 to $10,000.
So if your roof repair bill is exactly $10,000 and your new hidden deductible is $10,000, wait, the insurance company legally pays you $0.
Zero.
You pay premiums for years, your claim gets fully approved by the adjuster, and you get absolutely nothing. You are entirely responsible for the entire replacement.
It's a 500% increase in your financial liability triggered entirely by a thunderstorm.
Now, Scranton gets pretty aggressive in his commentary about why this is allowed to happen. He points the finger directly at state insurance commissioners.
He does.
He argues they've failed miserably to protect the public from corporate greed, and have essentially stripped away the guardrails of consumer protection.
Right.
Now, regardless of where you stand on state regulation or corporate politics, his underlying point is intensely practical. You are operating in an environment where you pretty much have to fend for yourself.
That perspective is vital. If the regulatory guardrails are down, as he suggests, the responsibility of protecting your household falls entirely on you. No one is coming to save your equity.
And if an insurance company is willing to deploy hidden weather triggers and percentage shenanigans to dodge paying for a basic roof claim, what else are they hiding in the fine print?
That is the million-dollar question. And it connects us to another vital yet entirely distinct part of your policy: personal liability coverage.
Now, let's be really precise here, because the source material is very specific about this. This is found in Section 2 of your policy documents.
Right.
Most people look at Section 1, which is the property coverage, and they just stop reading. But Section 2 is massive.
It is.
It covers the cost of legal preparation, the cost of litigation, and actual legal judgments if you are sued for unintentional injury caused to someone else.
And we need to clarify what that actually means, because there's a massive misconception here. When people hear liability, they usually think, oh, this is if a delivery driver slips on my icy driveway.
That was exactly my first thought when I heard the term.
Most people think that. But actually, slip and falls on your property typically fall under a separate coverage entirely called medical payments to others.
Oh, wow. Good to know.
Yeah. Personal liability in Section 2 is really about direct injury you cause. Think about hitting a wildly errant golf ball that strikes someone on the course, or your kid crashing their bicycle into a pedestrian on the sidewalk, causing a severe injury.
The coverage is incredibly broad then. It covers you, your spouse, your kids, and even if the unintentional injury happens out of state or while you're on vacation away from home, you are covered.
But here is the crucial connection Scranton makes. He calls it the rotten apple metric.
As in, one rotten apple can spoil the others.
Exactly. It's a behavioral metric for evaluating your insurance carrier. If you are dealing with a company that actively uses underhanded tactics, aggressive depreciation, and complex weather triggers to dodge a $5,000 roof claim, you have to assume they have manipulated the liability contracts in Section 2 as well.
Because if they won't pay for some missing shingles, they certainly aren't going to want to pay a $300,000 legal judgment when your kid accidentally injures someone.
Exactly.
You cannot trust a rotten apple to protect your life savings from a massive lawsuit.
A roof replacement might drain your savings account, but a personal liability lawsuit, that can result in wage garnishment. It can literally bankrupt your family and take the home away entirely.
Scranton actually offers a very actionable tip regarding the limits of that Section 2 liability coverage. The law generally requires a minimum of $100,000 in coverage.
Right.
But he strongly recommends holding no less than $300,000. And when I read the source material on this next part, I had to read it twice, because upgrading your liability coverage sounds like it should be incredibly expensive.
You'd assume so.
But Scranton gives his own personal example. He upgraded his coverage from $300,000 to $500,000. And the cost for that massive upgrade, it was $10 more a year.
Less than $1 a month.
You're telling me for less than a sip of a fancy coffee, you can add $200,000 in legal protection for your family. It is an absolute no-brainer.
It is, but here's the catch. You have to actively make that phone call. The insurance company isn't going to automatically optimize your policy for your benefit. They aren't going to call you up and say, hey, for $10, we can double your protection. You have to initiate the change.
So knowing that all of these pitfalls exist, from vanishing roof coverage to weather triggers to compromised liability protection, how do you make sure your policy isn't a rotten apple?
That's a great question.
And more importantly, who can you actually trust to help you fix it? Because I don't speak insurance contract.
Navigating the professionals in the insurance industry is honestly just as important as navigating the contract itself. Scranton breaks down the 3 types of insurance representatives you will encounter out there.
Okay, let's go through them.
First, you have employee agents. These are people who work directly for one specific insurance company.
And Scranton makes a really fascinating point about the psychology of dealing with them. He warns us, do not mistake great customer service for true representation.
That's spot on. They might be incredibly friendly. They might answer the phone on the first ring. They might send you a beautiful calendar every December.
Right.
But at the end of the day, Their paycheck comes from the carrier. Their primary fiduciary duty is to the company's bottom line, not to your household equity.
Then you have independent or captive agents. They run their own small businesses, so they aren't technically employees, but they are captive to one single carrier.
Right. They can only sell you the policies that one specific company offers.
So if their parent company relies heavily on ACV depreciation and 5% percentage deductibles, that is literally all they can offer you.
Exactly. Even if they want to give you a better deal, their hands are tied by their corporate limitations.
Which naturally points us to the third option, and the one the source strongly advocates for: the insurance broker.
An insurance broker is fundamentally different because they represent the buyer. They represent you. Okay.
They work with a multitude of different insurance companies. So if you tell them, I want a true RCV policy, no weather triggers, a flat deductible, and $500,000 in Section 2 personal liability.
They can actually find that.
They can. They go shop the entire market to find an unblemished policy that fits those exact parameters.
There's an interesting psychological trap that homeowners fall into here, though. Scranton points out that brokers might have a giant poster of a famous national insurance brand on their wall just to get foot traffic.
Right, the big names people recognize.
But he advises us not to shy away from unfamiliar companies. Just because a company has the biggest billboard on the highway or the funniest TV commercials with an adorable mascot does not mean they have the strongest legal contract.
In fact, the source notes that lesser-known regional carriers, the ones who spend their capital in actually paying out claims rather than national advertising blitzes, they often drastically outperform the giant corporations when it comes to actually protecting the homeowner in a crisis. So what does this all mean? We've covered a massive amount of ground today. We started by looking at why government catastrophe savings accounts are just a Band-Aid for a much deeper sickness in the industry's risk pooling model.
We did.
We walked through the brutal mathematical reality of how ACV policies use depreciation to gut your payout, and how weather triggers can secretly shift your flat deductible into a massive percentage deductible that leaves you paying the entire bill.
And we connected that property risk to the broader risk at the rotten apple.
Right.
Recognizing that an insurer who plays games with your roof is highly likely to play games with your Section 2 personal liability coverage, leaving your entire family's wealth exposed to a lawsuit.
The ultimate takeaway from John Scranton and Cash University is crystal clear. No one is coming to protect your equity for you.
Yeah.
You have to be proactive.
Absolutely.
Which means taking action today. Get out a magnifying glass, pull up your policy right now, and look at the declaration page. Are you ACV or RCV? Are there storm triggers buried in the text?
You really have to look.
Do not wait for your annual renewal period to find out you're underinsured. Because if you wait until the storm hits, you might find yourself pulling $20,000 out of your retirement fund just to put shingles over your head.
Knowledge, especially in the realm of financial contracts, is only truly valuable when it is applied. All the insights from this deep dive mean nothing if you don't pick up the phone tomorrow, call a broker, and demand a policy that actually catches you when you fall.
It's so true.
The power is entirely in your hands.
It really is. But before we wrap up, I want to leave you with a final thought to mull over. We've seen exactly how insurance companies use incredibly complex language and highly specific weather triggers to legally shift the financial burden back onto the homeowner to keep himself solvent. But as climate change accelerates and severe storms, extreme wind, and massive hail events become more frequent every single year, it really makes you wonder, will the very concept of full coverage homeowners insurance eventually become a total illusion? Or perhaps will true unblemished protection become a luxury that is only accessible to the ultra-wealthy?
It's a scary thought.
It is. It's something to think about the next time you look up at your ceiling and wonder just how strong your safety net really is. Thanks for joining us on this deep dive.